Hey everyone, I'm going to show you why the methods they teach you about calculating retirement expenses are dangerously wrong, and I'll share with you the right way to calculate what you'll spend in retirement so you don't run out of money. If you're watching this video, you may be getting close to retirement and have saved $1 million or more into your investments. But when you start adding up the high cost of living, inflation, and taxes, not planning properly can force you to reduce your standard of living or run out of money. The stress from this uncertainty can be magnified in retirement when you're not in a position to earn another paycheck. But the good news is once we recognize the inaccuracies of these traditional methods for calculating your retirement expenses and then apply a more complete and accurate way, you can rest easier, not only going into retirement, but have more confidence in your long-term future. So it's important to first understand the two traditional methods for calculating your retirement expenses and why they're typically wrong. First method is to add up your expenses. Essentially, this means writing out a budget. I see most people applying their best guess to their expenses. The second traditional method is to simply target 80% of your current income. For example, if you earn $100,000 today while you're working, this method would say that you need $80,000 to live on in retirement each year, plus inflation. This rule of thumb method is assuming your expenses will decrease. But each of these methods are typically inaccurate, and unfortunately, you won't know if they're wrong until you start living on those amounts. By that time, you've quit your job and you've stopped saving into your retirement plan. It's kind of too late at that point. So you might be wondering, why are these methods wrong? They each sound fairly straightforward. Let me show you not only why they're wrong, but why they become dangerously wrong, potentially forcing you to reduce your standard of living, or even worse, run out of money. So if we look at method number one, adding up your expenses, the worst way to do this is guess what you think you need. We need $800 for groceries, and our gas and electric bill is usually $200, and so on, as you would need to apply these estimates across every category you spend money on. So in addition to bills you write out, you need to include variable expenses like gifts, entertainment, vacations, and groceries, to name a few common ones. But here's what I notice. Most people far underestimate what they need using their best guess. Why? Because I see that like 99% of people think they don't spend much money. And while that may sound virtuous, they estimate what they think they can live on rather than what they actually spend. The last few years with high inflation have exposed this point even more. Can you think of a time recently you were at grocery shopping and thought to yourself, man, when did eggs or milk get so expensive? Or you're at a restaurant and notice that everything on this menu costs so much more. Now, if you multiply those little surprises across all that you're spending, there's a good chance you're spending more than you initially think. If you are very organized and you keep detailed records of all your expenses across multiple years and then average them out, this method can be accurate, but it requires a ton of work. And even then, most people forget the categories they spend money on. Now, I will say in rarer cases, expenses can be overestimated. And while this is better than underestimating, it can lead to overworking or unnecessary stress in trying to meet retirement goals. For method number two, the 80% rule, the reason this doesn't work consistently enough is because it's too general. It's too simplistic and doesn't factor in your personal situation. It might be close, it might even be right, but how do we know? And here's why all this matters. When you're projecting your cash flow for retirement, there are a number of important variables, but the most important variable in a retirement projection is what we're talking about today, and that's the target expense. How much do you need to spend? Let's see the difference this makes in a financial plan. I'm going to show you a retirement projection for Steve and Diane. Names change, of course, for confidentiality. A little about them. Steve will retire in 4 years and Diane in 3. They want to maintain their standard of living and have a plan to save taxes. They have $1.25 million saved in their investments, plus their home with a small mortgage. After that mortgage payment and income taxes, they initially estimated they need $5,000 per month to live on. They'll have some Social Security to complement investment portfolio withdrawals for their retirement income. Now let's look at if they can retire. Each bar represents 1 year of their life. And we've illustrated this to go out to age 95 for each of them. The size of the bar is their investment portfolio. It's essentially their nest egg. We've included a modest rate of return and inflation, and at $5,000 per month of expenses, their money could reasonably last for their lifetimes. Their projection looks good. And when we go ahead and apply a Monte Carlo statistical analysis, it has an 82% probability of success. That's relatively high. And the 18% failure rate applies even if they fall a dollar short. So when the probability is that high, you're most likely able to make simple adjustments to still be successful. But what if they underestimate their spending? Let's say their expenses are $6,000 per month. We can see now the projections take a big dip right here. It may still be okay, but it's fragile. And the probability analysis comes down to basically a coin flip at 55%. This is a fairly dramatic shift if expenses are just $1,000 more per month. And keep in mind that $1,000 may not be that bills are higher than planned. Often this miscalculation is leaving out special projects, repairs, or variable expenses. Now, it's possible this plan could still be successful. After all, this is on paper. Maybe they earn more on their investments, or inflation is lower than we're projecting. Maybe they don't live to age 95. We would also apply in real life a dynamic withdrawal strategy and tax planning to make their money go further. All these things can make it work, but the purpose of the projection as they prepare for retirement is to plan with a reasonable estimate so they don't need to rely on ideal circumstances. But let's take this a step further. What if they've underestimated even more than we thought? We can see by using $7,000 per month that they would then fall short as they get close to retirement. And then when we look at their probability analysis, it drops all the way down to 30%. This could have devastating consequences because when we think of the impact in real terms, if they're really spending $7,000 per month, but they're forced to reduce to $5,000 per month or something close to that to make their plan work, they need to cut out $2,000 every month. That's a huge reduction. And this is why accurate expenses are such a big deal in planning for retirement. The expenses can move the needle quite a bit for Steve and Diane. The composition of your income, investments, and expenses all may have varying effects. And while we know that life will never be a straight line, your retirement expenses will never also be perfectly lined up. There is a more accurate way to calculate your retirement expenses that's based on your actual spending. We call it the live, give, owe, grow method, which can allow you to transition into retirement without taking a pay cut and without worry that your money will someday fall off a cliff. It's also easily adjustable if you know that going into retirement, you intentionally want to either tone down your standard of living or what's more common, dial up your standard of living, perhaps to travel more. First, let's look at what the live, give, owe, grow method is and why it's more accurate than traditional methods of estimating your retirement expenses. And here's what most people miss. The two traditional methods that we've already talked about are what we're taught to use. And conceptually, they are pretty simple. So introducing a new way of calculating your retirement expenses leaves some to think a new, different method must be more complicated. It's actually not, though. The hardest part about calculating your expenses is not your standard bills. Like if you have a mortgage, it's usually a fixed payment. Even paying something like your phone bill may be fairly consistent. What most people miss are the variable expenses like groceries, gifts, entertainment, repairs, and the list goes on. So this method is simple because you don't need to track your spending and add up a bunch of small expenses. It's easier and more accurate. Let me show you how. Okay, so we'll use this spreadsheet to do the calculation, and ultimately what we're trying to get towards is this current living expense. I'm going to show you how we got there. So the first thing we want to do is add up everything that's coming through as far as income. In Steve and Diane's case, they each have salaries that adds up to $167,000. If they had other income sources like rental property income, or if they already started to get some retirement income from, say, like a pension or Social Security, you'd want to go ahead and include that here. And then we start subtracting out what I like to call larger itemized expenses. So we start with the category of taxes, and we have payroll taxes because they're working right now. They have income taxes, federal and state, and then they have property taxes. They're also saving into their 401k. If they were saving towards other places, like regularly into a bank account and not touching that money, they could add that in here as well. Under insurance, we don't have anything specific. They are paying for auto insurance and homeowners insurance. We actually have that rolled up into the living expense. What we would tend to include here is if they had life insurance, that may drop off at some point. But you can include it either way as long as it's accounted for. They have debt. Their only debt is their mortgage, which is a fixed rate payment of $16,000 per year. And they have charitable giving in the amount of about $10,000 per year. So we go back up using our calculator. Again, we have our income, and then we subtract out these other itemized expenses in the categories that we just talked about. And then that drops down to the bottom line, everything else that they're spending money on. In this case, it's $5,500 per month, again, compared to their $5,000 per month. Now, you may have noticed over here as I was scrolling down, this chart that shows these categories. And this is the live, give, owe, grow. So we have their living expenses, which is one of the 5 ways that they could ultimately spend money is living on it. They could give it, or they could owe it, either in the form of debt or in the form of taxes, or if they could grow it through their savings. In their case, they're saving 11% of their income. So this now includes everything they spend money on, including what we call living expenses, which is everything not itemized down below in the spreadsheet. These other itemized expenses in the categories I showed you, they'll be factored into the financial plan, but we're separating them from the big pool of everyday expenses. The reason for separating these out is they may drop off at some point. So your mortgage payment, payroll taxes, retirement plan contributions, those are all examples of expenses that may drop off going into retirement or sometime once you're in retirement. Expenses like charitable giving, they're best to itemize because of the tax deductible character. If you want, you can keep these in the bucket of living expenses as long as you're accounting for what you want to spend or give in this case. But separating them out may allow you to be more precise for tax planning if you're running a projection through software like I am that's calculating the projected taxes. Now that we have these living expenses based on what they're actually spending, which is $5,500 per month, we can go back into our projection with a more realistic and accurate retirement expense that's based on what they're actually spending. And maybe you're thinking one of 2 things. Okay, $500, big deal. Well, it does materially change the projections, as I'm going to show you, because that $500 is calculated every month for the next 30 years or so. So then you may be thinking, well, spending can change anyway. There's no promise that what we calculate will be perfect. And I would agree with you on that. Life will change. But going into retirement, being accurate, even if things may change in the future, helps you to prepare differently if needed before it's too late. And I should say, before we see what this looks like in the projection, we can also apply any adjustments if needed. Maybe this is to include travel that you're not doing now, or maybe your cash flow is tight and when you get into retirement, you want to aim for a little more breathing room. Well, you can increase your target expenses needed. You do, though, want to be careful about decreasing your living expenses just to make your plan look better. If there's a real reason why you can or should live on less, you can cautiously reduce the living expense. So I've added $5,500 per month into our target scenario, and we could see that spending the $500 per month, it does reduce the projection a little bit, as we would expect, but it still looks solid. The probability then drops to a 68% probability of success. That's still pretty decent. But what it allows Steve and Diane to do is work to get that up over the next few years before they actually retire. Couple that with a dynamic withdrawal strategy and tax planning once they get into retirement, all these things can help them to be successful. So how often should you update this? From here, and even as they get into retirement, we should revisit this projection yearly to see how it's going and if any adjustments need to be made. Now, you may be one step ahead of me and wondering, okay, once I'm on track to retire, how do I transition from saving for retirement to now taking income from investments and then coordinating that with Social Security or any other income sources you have? Which account should I withdraw from first? Do I need to stick with the 4% withdrawal rate? You may have also heard me mention a couple times through the video how a dynamic withdrawal strategy and tax planning can maximize your retirement income. My partner Alex answers all those questions and topics on a previous video called Where Should I Take Money From First in Retirement? You can see that video in the link above or in the description down below. You should definitely watch that next. Once again, I'm Anthony Saffer, CEO and certified financial planner at 1 Degree Advisors. And if you'd like to talk to someone on my team about your retirement plan, you can click the link in the description and we would love to talk with you.